Okay, I'd like to do just a little introduction. Edgar has the honor of being one of our best reviewed for his previous summit performance, if you will. His summit presentation was one of the best reviews that we had feedback on. So congratulations on that.
Oh, that's great. Thank you.
Very well received.
No pressure. No pressure.
Yeah, we'll see if the next album is good.
And even with your face being in the end. Yeah.
Oh my goodness.
But the feedback of it was that we talked about standards, and having been very involved in ISO standards and ANSI standards and so on, it's kind of can be a little dry reading because of the process that goes through it. But what's really important about these standards is we take the standards and we apply them. We take what's good about them and we apply them, and that's what Edgar has been doing. And so he's here to talk about a new standard, one we haven't talked about again, so I'll just hand it over to you.
Thank you. Really appreciate that. I'm going to mostly focus on the topic today, but I am going to be referring to it because it's what we're going and commercially intertwining with what we're doing at Avasta. So for those of you not familiar with what Avasta is, we're the profitable growth company. And it took us 4.5 years of research and applications and figuring out who the heck we are to realize that who we are is a company that is at the intersection of disciplines. So we're management consulting, customer insights, and financial data analytics intersect. And what we've gone and seen is people have tried to do one or two, and they keep running into failures that are repeated by the third. So you might get great financial insights that doesn't align with what the customer wants. You might have a great management consulting idea that doesn't align with what the data goes and shows. So that's kind of where we're at. So today's going to be a bit of an interesting smorgasbord, I think is the best way to go and put it. Because I will be talking to you about standards, and then I will also be talking to you about the benefits of implementing some of these standards. And there's a big gap in the middle. You know what that gap is? Making it happen. So the case study that I'm going to be walking you through is 2.5 years worth of client delivery, 6 years of data, and several thousand hours of joint implementation between us and our client. And I don't think it's going to go and do it justice. So I'm going to apologize in advance, which is why I've created this presentation to give an opportunity for you to ask questions as I'm presenting it. And if we get really deep, we'll just sidebar it, and I can answer to you separately at another time. So on that note, let us dive in. I'm going to give you some background, walk you through the fundamentals, give you some historic examples that kind of reinforce why this thing is, walk you through a case study, and then hopefully there'll be some time left for discussion and Q&A that hasn't happened during the course of what we're doing here today. So how did we get here, and why does the standard exist? And I really want to appreciate Frank and his generosity in allowing me to go and send this thing to him yesterday, because in conversations with people about the fact that I was speaking here today, I got reminded of being in a similar position at NYU Stern about 10 years ago when I went and presented this visual. And it was a bunch of longitudinal work using almost 10 years of data, which I got access to as being both an academic and as an independent practitioner, where it came from several dozen of the world's 200 largest companies who were wanting to understand why were they losing their momentum over time. And what we learned in that synthesis of data at that time that we presented at NYU Stern was that companies were reporting on the positives, but not reporting on the negatives. Karen, thank you for the great plug, as you went and said. And then they were surprised when competition emerged. And why this matters is because 1.5 years after this, I started working on the brand evaluation standard, which some of you may have gone and heard about before. And then 1 year after that, I was invited to co-chair the development of the intellectual capital in the boardroom standard. So what the heck is this intellectual capital in the boardroom standard? I have some slides in here that I'm not going to read out for you. I'm going to invite you to just kind of scan through them. I'll give you the summary. Some of them, you're going to get a copy of this presentation, go back and reread them. This is not a lecture, all right? The whole purpose of the standard, why it came out, was the Licensing Executive Society, for those of you who don't know, is the largest organization of corporate lawyers with a focus typically around intellectual property, licensing, etc. And they kept hearing the same problem coming through their customers, Fortune 500 companies, Global 2000 companies, the Dow Jones members, etc., which is we don't seem to understand or know what IP makes us money and what does not. And they thought this thing could be written up in 2 years. Took us 6. And the reason for it is that the board needs to know what is going to drive value for the business in the future as a lens to guide around business strategy. That is a very different end to what we started with, which was most boards set objectives, and then the role of the executive in the business was to go and fulfill on those objectives. We got to the other side. What can you achieve under the existing circumstances? And the problem was there was no measurement or reporting practice to understand what the present circumstances were. So that's what the standard is about. What is the universe we're actually in? So, I'm going the wrong way. So why does this matter? Historical financial models, valuation models, many business school teaching methodologies, etc., are still based fundamentally, consciously, and mostly unconsciously on tangible business components. Over 90% of current business value in North America, over 70% of business value globally is intangible, and nearly all business models fail at properly considering the role of intangibles. And that includes most contemporary high-profile successful companies that we admire because their methods are not replicable across other organizations. So we see a success in one, we try and emulate it, it fails in other circumstances, and that's what we're talking about, they fail at properly considering it. Tangible economy is systematized and measurable until now, and I say this with a very big asterisk. The standard is the foundations for making it systematized and measurable, but it's not the solution for it yet because it still requires practice. So just like you can buy sponsorship, you can go buy the standard, but if you don't invest into making it happen, you ain't gonna get any value out of it. So why was it created, as I kind of built on it a little bit before? But there's insufficient definition of what were the non-financial success drivers for a business. So if I want to grow my business from $1 billion in revenue to $1.5 billion in revenue, what was still and continues to be happening is people would just go and say, it's 2023, we're at $1 billion, and we're going to grow to $1.5 billion by 2027. And people were not looking at what conditions would the marketplace have to have for our company to get to 1.5 billion. A lot of the information that is there at the industry level identifies that a company at $1 billion in revenue can get to $1.5 billion in revenue within 4 years. But what it was not taking into account was whether your company could get to $1.5 billion. And a lot of board decisions were not taking that into account. So most forward-looking guidance around growth was not taking into account the conditions required. Also, there was never a forward-looking baseline. So we would have a lot of financial targets that we would go and talk about. Well, we're going to get to $1.5 billion revenue. Well, what does that mean? Is it 1 million more consumers? Is it 300 more enterprises? Is it the same company, buying 3 more products on average per year? Like, what is that relationship that you need to go and have? And what it also was going and doing was that short-term budget cuts would increase near-term profit, and nobody would actually know if or when there would be an impairment in the future. One thing that we noticed in a lot of the development of this, and it's been corroborated in 4 years that we've been kind of commercially applying this, is there's this false illusion that people go and hold that if I don't spend $1 today, I can spend $1 2 years from now and get the same effect. Well, as somebody with kids, I can tell you, if I don't take the kids on vacation this week, and I put it forward 2 years from now, they're not going to get the same results. So these are kind of some of the things to go and take a look at it. And what is also there is there's way too high of a dependency on past results and growth rates as an assumption of indicator of future growth. And one of the best examples of this is Michael Kors, for those of you who are familiar with the brand. They grew, got private equity, went public, grew, and then they came out and said, folks, we don't think we're going to grow at 20% quarter over quarter, year over year anymore. Anybody know what happened to their stock when they said that they think it's going to drop to 18% growth? So they didn't lose revenue. The revenue slowed. What happened to their stock price? How much?
30%.
Worse.
Worse. Oof.
Almost 50%, and they never recover. And that's just because they fell below like the Wall Street norms of 2020, year over year, quarter over quarter. So the reason for it is that they just ran out of people. Like nobody ever bothered counting how many people had to go and buy Michael Kors suits and jackets and shirts and glasses and things like that. So why does this all matter? So I just kind of want to walk you through, call it the historic lens, which I think is really ingrained into how we go and build businesses. And I'm guilty of it. I'm the founder of a company. I see where I fall into the traps of historical performance. So we have the today view, and we have a future date view. That's the aspiration that we have. And we go and invest financial capital. But what is going on is, well, we go and have some TAM estimates. We think this marketplace is worth like, $30 billion, or gaming industry is going to be worth $67 billion next year, et cetera. We look at historical trends. Well, it's been growing at 11% per year. I'm going to assume it's going to keep growing at 11% per year. And then we go and set financial targets that are there. And at some future date, we're going to go and have financial outcomes. Now, I'm being very objective here with that statement. Usually what it is, we're going to have higher financial outcomes. We're going to have better financial outcomes at a future date. But what is going on is that companies are consistently misestimating growth. So it's not that they're falling short on growth, they're misestimating it. So what it means is that like, well, we think we're going to grow 14%, and then we grew 37%, and we didn't know why. Until we went to the trailing analysis, and then what happens? It becomes the new historic trend. They're like, oh, look, we used to grow at 11, now we're growing at 34. Well, the 11 was wrong, let's put the 34 in as the correct growth for the performance. And you start going and having those failures. And then what happens is that remaining growth potential is frequently unknown, because people never bother identifying what is the limits of the population. And this is where, as somebody who's a practicing mathematician and statistician, where stats fails. Stats typically does not have a count or time component. It has a probability or chance or percentage component. And it doesn't care whether you're going to go and have more people or less people in the future. It's just going to tell you what the ratio is going to be there. So you have to come up with alternative solutions to get so. So you actually have to bind your knowledge base, which most people feel very uncomfortable with. So if you apply the intellectual capital and the boardroom standard conceptually, and I want to really convey this is a concept. This is called a qualified theory developed by a collection of individuals and organizations around the world. Baruch Lev and his the accounting book and his contributions to how the accounting side had to be done and looked at here. Countless of other folks in the legal and commercial arena and the companies who are part of the review. So we have the same thing. But now what we have is we have financial capital invested. And the standard essentially goes and says, look, you gotta go and filter it through the lens of these three capitals: human capital, relational capital, and structural capital. And I'm really, really stripped down what the heck I mean by this. We're gonna expand on them in a moment. Human capital is the capability of your organization to go and get the most out of its workforce. So if you have a high amount of people entering and leaving your company, you have a really low human capital. Relational capital, the simplified way of describing it is market demand. And it's not just customers, it's kind of like the whole ecosystem that makes your respective engine go around. So if you're a B2B company, you probably have channel partners like professional services firms or distribution companies. If you're a CPG firm, your market demand is heavily driven by retailers. One of the most funny things that I've ever gotten to experience is I was working with a niche Latino brand a number of years ago, and at the same time I was working with a domestically North American creative brand. And because of population dynamics, the Latino brand all of a sudden just started adding tens of thousands of people per state and country, in the case of Canada, coming in. And it would just be tens of thousands of dollars to go and list your product on retailer shelves. And the retailers were coming to them and said, we're going to waive. Why? Because they wanted that foot traffic. They wanted to go and get those people to come in, because there was market demand that changed how the retailers went and behaved. Same thing is going and happening in B2B. The third one is structural capital, and this is both intellectual and process. So I want to emphasize something that's really critical here. None of these things are physical. The closest physical thing that you go and see here is like the printout on your patent application, and maybe the stamp that you got from the USPTO, or something like that. So IP and process, and what process is this is how we do things in our company, that I can go and take it from Joanna and I can hand it to Mark and he should be able to get it done around the same way. So we also go and get financial outcomes. The very big difference that's here is by going and measuring what your human capital is at present and its potential through investment, same for relational and structural, you can start identifying what your probable maximum financial outcomes can be. That's the philosophical shift. So this is not fortune telling, this is going and improving your odds of success. So why is this critical? Because it gets to what I have gone and seen in the 2 years that we've really been deploying this is why, how, and when will the company make money? Because if we go back to this view, CAM estimates, historic trends, and financial targets will not tell you how, why, and when. And the biggest trap that we're going and seeing, you'll see it in the case study, is that companies are misunderstanding when, why will the money be made. So what it does is identifies most effective pathways to reach goals given the information that you can go and collect. So this is not a perfect system, it is a more enhanced system. And then critically, it identifies residual value of past investments that are lost in annual reporting. And I'm going to put an asterisk on this. It identifies residual impairment of past underinvestment or misinvestment that is lost in annual reporting. I will not mention the retailer by name, but many of you will probably recognize this. We did work with a prominent retailer which went and had a number of scandals and lawsuits that was there. And they had them across multiple years, over a couple of decades. And what ended up happening was that once they paid off those lawsuits, they disappeared from the financial statements and the reporting. But do you think people miraculously started buying again after it was announced that they won or were settled out of court? No. They actually reduced the maximum share of the total population that would ever go and buy from them. Same thing happened with a prominent airline company, which managed to go and pull a doctor off a plane. They reduced the maximum potential share. Their near-term effect wasn't dramatic, but their absolute limits were impaired in the data that I was able to go and get access to.
So I'm sorry, quick question.
Yeah.
Are you, when you talk about that, the absolute population being impaired or enhanced in every way, right? So in B2B, and to some degree in B2C, this is the idea of an ICP.
Yep.
Right, is that what you're talking about?
Yeah.
Okay.
Yeah. It's ideal customer profile for those of you who don't know the B2B terminology that's there. And what it is identifying how many there are. So a lot of organizations define an ICP, but they don't determine how many of them are available to them.
Right.
At best, they might get to how many exist in the marketplace, but they don't evaluate how many are accessible to them. And that's
the other thing, which I think is to your point, is that a lot of companies, so the ideal ICP is a very, very small fraction of the TAM.
Yeah.
But a lot of companies don't like that idea. Right?
So as a little plug for Avasta, that is our core business model. We identify a winnable addressable market, which is primarily focused around B2B or channel-dependent B2C, where we're going and determining what share of the market would actually buy from you, which is very different from what share of the market would buy the category.
Yeah.
Okay. So that's kind of called the basis that's there. So let's go to the fundamentals. This is the dry stuff, okay? Take your swig of coffee now, okay? Or forever hold your peace. Okay, so what the heck is intellectual capital? Because it has wonderful words in it. It's got intellectual, it's got capital. Those are both good things, right? So what it is the sum of everything that the enterprise knows and has created and has the capability to know or create. And a lot of this is kind of taken for granted inside organizations. This is the actual formal definition. This is the global one from OECD that is the basis of the standard. And let me kind of put it in slightly different ways. So it's the non-physical ecosystem of the company that generates value. including what is beyond the company or the organization itself, if we're talking about, non-corporations. And it identifies why you go and generate value, when, and how. So you're measuring both what is the present state, and you're also measuring the potential state, and the potential state includes upside and downside. Please.
I'm trying to wrap my head around the idea of intellectual capital. How do you operationalize it?
We're going to get there. We're going to call it the abstract of the abstract right here. All right? So a component, the main three kind of taxonomy underneath intellectual capital is relational capital, human capital, and structural capital. So let's kind of like dive through those quickly. So relational capital, sum of all resources that is there from your external relationships, etc. So another way to look at it, it's the entire demand ecosystem of a category of products. So one of the things that is difficult for a lot of organizations to understand is kind of called a big RC, relational capital, which is like everything that you can be, and then the small RC, which is what you're actually going and deploying or activating at any given time. So you can have different relational capital in Europe than you have in America, even though you have a large kind of superstructure of relational capital that you can go and measure. And you have, a company has positive prospects if your relational capital is higher than it can fulfill on to a limit. Meaning that like you can have like great demand, but if you don't take advantage of it, somebody else is going to come and take advantage of your ability not to fulfill it. And we've probably seen countless examples of that through history. So human capital is called the sum of the professional and tacit knowledge, and Parush is to help you. This is what you take away with you when you leave your university office at 5 p.m. Okay? So it's what you know that isn't documented that somebody else can't pick up.
But how do you quantify it?
Well, you quantify it, depending on the quantification is, you quantify it by identifying what is not quantifiable and what is kept inside the company. So, a great example of it right now, call it a local concentration, is the spike in AI engineer salaries. There's just not enough AI, trained AI folks, so their salaries are going up really high because the structural capital of how to go and develop AI programs isn't diverse and robust enough in the marketplace that those salaries can come down. Versus if you were like, call it a general computer scientist, which was in high demand 20 years ago. Now that a lot of people are computer scientists, the human capital demands for them has gone in decline. So this is both a market effect and an internal effect. Yes?
There's a baseball statistic that wraps in replacement value.
Yes.
It's kind of what you're talking about.
Absolutely. It gets like, as we've been going through this and we've been implementing this, if you're at all into sports or fantasy sports or anything like that, you're just going and seeing that, my gosh, like we're building out like the fantasy sports ecosystem for a company in these situations, and the reality is that actually is the case.
But that actually is a question of mine. Going to Scott's point,
Yeah.
replacement value is relatively less complex to quantify because there's one thing that you're going after, the baseball players' outcomes, performance, right?
Which is,
let's
yeah,
talk
keep
about
going,
this, right? I teach, I do research, I do administrative work,
yeah.
I have relationships beyond the university. How do you quantify that?
So a lot of it is by identifying, call it the universes that are there. And again, you're not boiling the ocean and trying to figure everything out. You do still have to apply like some kind of a trade-off, but I'll kind of show you the taxonomy that is built inside the standard momentarily.
So would a shorthand for this
Yeah.
in a corporate environment be, this is usually pretty ad hoc, okay, but the extent of the transition period when a person says I'm leaving?
And the impairment of it.
Right.
So a CEO leaving a company,
That's a great idea. I like
Yeah.
that actually.
a CEO leaving a company abruptly and the stock price declining is, call it the collective wisdom of that CEO being more valuable there than not being there. We've also seen the counterance of it. I think a number of years ago, the CEO of United got, I think, criminally indicted or something like that, had to leave, United stock price went up. So like that would be kind of like an example of it. So there's different metrics that are there. The point about this is to start counting things that you historically might not have counted. It's like, that's probably the most basic way of kind of looking at it. So structural capital is called the most tangible and explicitly measurable aspect of it. But even there, what we went and learned through the development and the implementation of the standard is that you went and got a lot of false positives. So people were going and tracking, well, how many patents were being registered by companies, or how many trademarks or copyrights were being registered. And what you went and identified was that that was not necessarily a driver of profitability of companies in the future. So you have to be able to figure that part out. So again, very kind of long OECD definition, but it's, you know, it's the company way. So there's, call it the way that one organization does it, like there's the GM way, right? The GM would have gone and done some things differently, that if somebody showed up from Toyota or from Mercedes-Benz, they would have been like, oh, we don't do these things the same way in our company.
Would you say that this is meant at some level to be a counterbalance to human capital?
So,
It's almost like in an agency,
yeah.
right? In order to even out the ebb and flow of talent, agencies and consultancies in general tend to try and systematize and productize a service.
Yeah.
Is that what you're talking
That
about?
is exactly it. So you're taking human capital, you're converting it to structural capital. The business owns the structural capital, enforces it legally through IP protections, contracts, etc., and goes from there. So the closest thing that we have to tangible aspects of this, and I'm not going to show this to you because it's huge, but we actually went and reconciled the most commonly and uncommonly, not the rare, you know, edge cases, of the commercial versus legal versus accounting treatment of what generates value inside a company.
But one of the aspects of human capital, speaking of the GM way and others, is knowing how to use the structural capital, how to use the process.
Which is in itself a structural capital.
But that knowledge, the knowledge that the person has of,
So
how to operate in that process, you're putting that on the structural side or the human side,
So if they leave tomorrow and they don't come back,
right?
if you can replace them, it's structural.
Sure.
If you get impaired, it's human.
Right, you
It's
replace
also-
it, okay.
It's also like, I got a lot of skill learning how to use the Honeywell operating system,
Right, exactly.
okay? As soon as I left, I mean, other than the value of that in the abstract, to maybe teach some of that somewhere else, okay, the value was nil.
Right.
Because in the context was different. The Honeywell operating system wasn't in place
Right.
at BMC's operating.
There was a study of industry analysts about 20 years ago, probably, and they took the top-rated analysts from Institutional Investor magazine, right? So this is basically votes. Institutional magazine ranks industry analysts
Yep.
from buy-side investors. Who's the best analyst? And when the analysts changed firms, right? So they went from Merrill to Goldman, right? Their ranking almost always went down. Same person, same industry, right? Going from Ford to GM. In this
Yeah.
case, or from Goldman to Morgan Stanley, their ratings always drop.
It is a perfect example of kind of looking at it, the premium that is there. The more structured a role inside a company, typically the lower the pay premium. So I don't know, for those of you who may not be very familiar with kind of like trading arms, like commodity or stock trading arms of banks, some traders earn more than the CEO. And they're heavily coveted. They have major golden handcuffs kind of built into them because that person being paid, $8 million a year is probably making $300 or $400 million a year for the bank. So that's kind of like an example of balancing that. And it's not a replicable skill. You can't just go and take him out and bring Brian in. Brian says, here you go, keep going, do whatever he did before, right? Like that's pretty much the way to look at it. So kind of how to take a look at it, and what we've learned, and it's been reinforced now, is customers can distinguish the differences in structural capital between competitors. So you're like, well, duh, that's really obvious, but I really want to emphasize this. At the board and C-suite level, as we were going through this work, it was kind of sometimes deemed unconscious. Like they didn't realize the magnitude of the ability to go and change it. Of customers to be able to distinguish it, sorry, in terms of what's there. Yes?
This, I hope you're going to address, because surely the interesting thing about this is it's great to use it to define the limits of what you can do and set goals and to stop it falling apart if there's bits that really matter. But isn't the interesting thing to discover, once you've discovered what your goals and limits are, is to use that information to then change your structure so that you can then change the goals and remove the limits. Isn't that the point?
You've absolutely captured it. This is why I'm saying there's a big RC or big IC and a small IC. The big one is understanding beyond the confines of the organization, and then who and what your ability is to navigate through it. So the best applications of this have been to go and identify where you can have a competitive advantage over your competitors at taking advantage of a market opportunity that they cannot. So you
By
pivot
changing your structure.
by changing your structure, call it taking the large relational capital in the market that nobody has claimed yet, and directing it towards yourself.
Which is exactly, it's expanded. It's
Yeah.
the same idea as brand valuation. You understand how your brand drives value. I'm not sure you even know how much it's worth, but so you can identify how to change your brand to create more value. This should be how to change the whole structure of all your ICP to do that.
And that is the perfect transition to what is the standard. Joanna, did you get a copy of this? So it is a reconciliation between the commercial, accounting, and legal realities over time of the forward-looking strategy through the lens of intellectual capital. And this is a self-directed guideline. So I want to emphasize, this is not call it a compliance standard where you must follow this thing, and like it's prerogative, it's a self-directed, implemented set of guidelines. And it's also a reporting ledger between the two. So what does it do? So it creates an across the organization definition of market opportunity risks that is there. Formalizes the internal interpretation of what will drive revenue and profitability in the future. So we're getting kind of out of the near-termism that a lot of organizations fall into, or repeating of current success. And then regularly tests the current and potential market demand using the brand evaluation standard. So going and understanding from using brand as the currency between you and the market to calculate what is the demand that's there. And I really want to kind of emphasize that part of it because there's a lot of different definitions of brand and brand valuation and brand evaluation. And where kind of this really came to is using brand as the currency. So people may not be able to give you money, but they may be able to give you attention. They can give you money in the future when it's opportunity for them to go and buy. So brand becomes a currency measurement, and you're able to go and figure that out. And as I kind of walk you through the case study, you can understand it.
Can I just this is a tangent, but I meant to say this during the dictionary conversation, is can we put brand on the list of terms that needs to be looked at regularly and redefined? Because, you know, everybody uses it. I was having this conversation with what is brand, big B, little b, somebody was saying. And, you know, there is brand, if you're P&G, your brand is a business. Papa's is a brand, and they're not talking about the feeling that people have for preference of brand over Huggies. They're talking about their business, their several billion dollar business, as the whole thing. But that's not how, if you're valuing the brand, you're looking at it. You're not looking at the whole business. You're looking at what is the associations with the differentiating characteristics of the company that lead people to buy from you, which is completely different. But they're both.
I think that may be, that's what people are probably trying to get at when they use the term brand reputation.
Correct. Brand valuation, brand reputation. What people are really trying to understand is what I have gone and built, or what we have gone and built, going to drive future revenues more so than what we could achieve in the past, or at a more efficient way than we achieved in the past or at present. That's kind of called the really simplified way. This is why I'm saying like brand is currency, because the brand definition is it's what's in the hearts and minds of people. And that is a wonderful thing if you kind of have, call it the individual authority to make the whole choice yourself. But it gets very hard to use that definition of brand when you get into multi-person buying decisions. So, you know, if you're in a family, it's not like one parent just goes and buys a van or a car or a sports car or a truck and comes home and says, hi, I just went and made a unilateral purchase decision for this thing for $45,000, you know, accept it. Like, it's not there. So at the brand at the level of a family organization or a group or an organization requires more nuance and complexity. This goes and gives kind of an opportunity to do so.
So let me, before you go into your case study. So in B2B, large B2B, really expensive, perceived high-risk B2B purchases, right? Brand is most often thought about, like if you have the conversation with buyers, you just listen to where they talk about all this, whether they use the B word or not. It's an insurance policy.
Yep.
I've heard, I had a conversation a couple of years ago with the CMO of Four Seasons Hotels, who basically said we sell travel experience insurance. If you can pay the freight to stay at our resorts, we basically guarantee you'll have a fabulous trip, right?
Which is similar to what McDonald's was going and doing in their global policy, where you should be able to have the Big Mac experience regardless of what country you're in.
And which is exactly the point, and I was going to say that.
Yeah.
Why do people go to McDonald's in the centre of Milan when they're surrounded by wonderful restaurants that, you know,
Right.
including ones at decent prices? It's because McDonald's is an insurance policy. They're probably not going to get poisoned. You know what you're going to get, whether it's you're trading down in terms of quality, but you're doing so because you're minimizing risk.
That's exactly it. That's perfect.
So would you say that brand is, so I'm being colloquial on purpose, okay? That brand is grease on the deal?
So it depends, because when I get into like the full case study, it's definitely, it's not the grease on the deal. It can also determine, do you even get to participate in the deal?
Oh, yeah.
So that's another big part that's there.
But like the relationship between brand
Yeah.
and deal velocity.
Yeah. So the kind of the big part that's there is the best organizations have strong brands inside relational capital, and they have the human capital to leverage that brand in new innovative ways to drive business value. And they have the structural capital to systemically keep leveraging that brand in the future. So that's kind of a way to take a look at it. So what the ledger does is it kind of creates kind of an inventory of what you have, and then a requirement to go and test whether your interpretation of market demand and your ability to take advantage of it matches what the market is going and saying. That's kind of the most basic way to look at it. And you track these things. So a big part that's here that we mostly relate to is like we have R&D, our company's investing millions, billions dollars into R&D. We know, we don't know which of them is going to go and generate value, but we trust ourselves enough to be able to convert things into value. And I'll give you an example of that momentarily. So how is this different from present practices? So when the benchmark ledger is implemented for companies, it's identifying what, if anything, has to be changed or leveraged from, call it latent value, in those capitals to hit future financial targets. In implementing this with our clients, we've gone and seen that they have set financial targets that cannot be achieved given their present combination of human relational and structural capital. But they have permission to take advantage of the market opportunity if they change how they operate. Does that make sense? So if they change and become more oriented to what the customer wants, the customer will say, we'll allow you to go and sell these goods and services to us. But as you're doing it right now, we're not interested. It also goes and identifies along past investments in asset creation, maintains residual value. And does it require sustained investment, meaning that you have to keep activating it? or does it actually drive value with no additional capital added? So a very simplified example is, we've signed a bunch of 10-year contracts. We don't need to go and do anything to those 10-year contracts. During the life of those contracts, we're going to earn that money. That's a very kind of loose interpretation, but that would be kind of a simplified version of it. And what it also does is what we've heard about in this room is gives a common basis for evaluating the importance of investments and activities that are not generating financial returns presently, but are necessary to do so in the future.
How do you account for environmental uncertainty? So I don't know which competitors are going to come in with competing products and services. I don't know what innovations are coming in.
Yeah.
I don't know the stability of my customers, how long they're going to be in business. Where do you account for that?
So the call for it is you go and put this, similar to what was shared earlier, set a timeline that is kind of responsibly representative of your industry. So if you're in B2B, 5 years is probably pretty responsible.
Even that has some uncertainty.
But the point of it is that you don't do this once and hope that you got it right. That you set the baseline and you have periodic testing against expectations. You're setting expected value by understanding the marketplace better. And as things come in, they increase or decrease in importance and priority.
And you have variance around expected value?
Yeah, you can go and set that, especially through market segmentation. Like relational capital, using the brand evaluation standard, it gives a very good understanding of the distribution of why a category is being purchased and why your company is purchased or not. In B2B, for switching, it has been instrumental in providing an advantage. If the market has become mature and you're trying to facilitate switching behavior, you can find out what are the conditions to why people would switch to you, as an example. So I'll give you some historic examples and I'll dive in. So those of you familiar with Nortel, this is at one point a company worth over $100 billion or something crazy like that. And in 2009, they declared bankruptcy. Their stock dropped by 80% on the announcement from their already low levels. They were down like 99% from their peak. And then during that bankruptcy proceeding, the intellectual capital and the intellectual property, almost none of which is on the balance sheet, was valued and sold for $4.5 billion. So what the heck? So the issue was that all revenue forecasts in the company that kind of gave it its pessimistic outlook was predicated on equipment sales without any attribution to the underlying brand, patents, third-party dependency for service contracts, etc. There is most of the 3G universe that your phone sometimes still goes and uses was built on Nortel and still runs on Nortel, and a lot of it still has not been ripped out. So, from the intellectual capital and the boardroom perspective, they could have gone and documented the structural capital that they had and valued it based on the present and future demand, relational capital in the market. So how long was this thing going to be useful for us? How long could it go and generate value? Could we structure a contract differently? So instead of build and sell and get all the money up front, should we build and license? Should we go and advertise our deals? There's a lot of commercial opportunities that could have become possible for them. And then what was also possible there was that they could have gone and measured how large the Nortel ecosystem was. If you look at Nortel, each annual result of their financial statements was what equipment sales they had that year. But there was very little reporting in their financials of what was the cumulative sales that were still being active and in use in the marketplace. And that is kind of like a big part of what gave them an illusion that they were badly off, when in reality they were actually worth a lot more. In conversations that were had during the development of the standard, Nortel came up many, many times as an example. There was estimates that if they had not declared bankruptcy, they could have sold their portfolio for over $10 billion. So the bankruptcy impaired the value of their IP by more than 50%. So I'll give you another example with Kraft Heinz. This is something that Jim Gregory and I looked into several years ago at the time that they went and IPO'd and they valued their brands under the new MASB guidance that had come out. And they communicated the value of the brands that was there. And within a couple of years, many of the brands had to be written off, partially or fully, because their performance had fallen at least 10% relative to their 2015 valuations. And this kind of goes to the Moribund effect that you may have been hearing about today or in previous MASB conversations, which is, hey, well, this is the value that we went and had. Now, the problem for Kraft is They went and valued their brands based on historical performance, not based on future demand. So if they had actually gone and taken a look at what was the generational demand for their products, they would have gone and identified that the younger the person was, the less attachment that they went and had to the Kraft Heinz portfolio. And that kind of got validated very quickly a few years later, where this went and showed the fact that that was in fact the case. The younger the generation, the less likely that they were a loyal Kraft Heinz consumer that might have been buying it since the 60s.
So what's the effect?
Go ahead.
This is sort of a rhetorical question.
Yeah.
Right? What's the effect of environment on what you're talking about here, right? Because, so valuing a company on a forward-looking basis is kind of like the cornerstone of tech software startups, right?
Yeah.
Except in the period that we're in right now, where everybody kind of like goes on the wagon, so to speak, right? And all of a sudden you're valued based on your last 2 years of performance.
So this is a re-education of the market piece here too.
Right, no,
Yes.
yeah, and so there, and I'm drawing kind of a binary construct because that's the way it actually operates, unfortunately. But there is that middle ground that you're talking about, right? So when you kind of, just talk to that a little bit.
I'm going to use the next example,
Okay.
which is Qualcomm. How many of you are familiar with Qualcomm before I give the details? Some of you are? Okay, so how many of you know about their 20% of revenue policy? So they had a policy that 20% of next, I think, fiscal year or next 2 fiscal years' revenue had to come from R&D in the previous 5 years.
Okay, so that's the time lag.
Yeah.
So Qualcomm is not only did they have that as a policy, but they were also investing 25% of their trailing revenue in R&D. So this to us is an example of a company that kind of, in its own way, espouses what the standard is about. Rather than treating their intellectual property rights that they have every time they register a patent and corresponding trademarks and copyrights as indefinite life intangibles, they've gone and systemically evaluate how long any R&D that they go and commercialize lives, and they know that it typically has 8 to 10 years at best, typically about 4 to 6 years. So what they've gone and done is they've been in this constant R&D mode. They're constantly coming up with new technologies, enhancement, lateral activities. So this is somebody that's kind of operating under these principles. When we were developing this standard, some of the companies that were part of the development committee were very reluctant to share their own methodologies. They would review and propose methodologies, but they were reluctant to share their own in the collective wisdom because they viewed how they manage their intellectual capital as proprietary to themselves. Hence, what the middle ground that ultimately came from this was, this is a set of principles to follow. It is not a step-by-step instruction manual. Because these companies that were party to this, they kind of, call it overarchingly said, this kind of looks like, sounds like, smells like what we're doing, but it's not the same components as what we have. So if somebody else wants to go and do this for their own benefit, go right ahead. But we're not going to give you our IP around how we manage our IC so that you can try and copycat it. That's kind of the basis of how it went. So Qualcomm is
human capital, systems capital funding.
Yeah, like exactly like you said about the Honeywell thing, right? Like Honeywell's not going and writing manuals for all the companies to come out and replicate the Honeywell way.
They charge a lot of money to consult with you on it.
Yeah. So there's that part that's there. So and what Qualcomm does is they're constantly investing into the next generation of human capital. They're going and getting the talent that's needed. An example that is not here, but it's from the semiconductor space because it's just kind of become very profile, and I read a bunch of articles about semiconductor challenges in the US in the past couple of years. When semiconductors was the big thing, corporations were partnering with universities, especially engineering programs, to go and have what I would say is more similar to what happens in Germany, where you actually have companies and educational institutions constantly in decline. But temporarily, like Lam and a few other semiconductors in America would go and facilitate all the way from undergrad to PhD and be able to go and graduate them. And they killed those programs once we reached peak semiconductor in the United States. So people stopped having an incentive to go into them, and when those people started retiring 15, 20 years later, guess what happened? There's a shortage of talent. Well, what's going on right now? We have a shortage of talent. It's taking twice as long to go and hire a semiconductor engineer in the United States as pretty much any other precision or specialty engineer. So these are kind of some examples. All right, so let's get into the good stuff. So this is a case study, and again, as my opener said, I don't think it's going to do full justice to this. This is kind of a very stripped down version of several hundred pages of reporting to the executives and the board of this company, but hopefully gives you a sense of what we're talking about here. So this is how we are presently implementing the standard, kind of following the instruction manual from the guide on behalf and with our clients. So we go and conduct a capitals audit. So we're literally going and taking a look at like some very basic, generally acceptable metrics around human capital, like what's your retention rate, what is your offer acceptance rate, what's your offer rejection rate, etc. We're looking at relational capital, which is going and doing the measurement of the brand in the marketplace to go and see why and how and when are people buying from you. And then kind of the corresponding structural capital. To be clear, with this company, this was not an exhaustive implementation, but it was one pertaining to their strategic question at hand, which is how do we go and get growth kickstarted again inside our company. And then what we do is we measure what the business objectives are of the company, but then we also measure the existing resources and constraints. And I don't know whether this is the bias of the experiences that we've been having at Avasta the past 4 years, but I have noticed more often than not, companies have started treating business objectives as the strategic priorities. Our objective is the strategy. And that to me seems really, really bizarre. The objective is the objective. The strategy is how you're going to get there. But we're kind of seeing a lot of companies kind of operating very kind of broad, simplified language of like, well, our strategy is to grow 27% in 3 years. No. Your goal is to grow 27% in 3 years. Your strategy is how you're going to make it happen. And I think that kind of is facilitating this. I don't know how universal is, Mark. You're much closer to this than I am in terms of your conversations, but this is the majority of the time we're running into companies no longer recognizing that their business objectives and their strategies are two separate things. They've become like this one hodgepodge.
Yeah, I'd say it's true.
Is it? Okay. So what we're then doing with our clients is we're taking those strategic priorities through the lens of the resources that they have or may get access to, which is called negotiating with the board, and the constraints that they have in the marketplace, such as, in this company's case, get more channel partners to sell their products on their behalf. And we're going back and seeing what do they need to go and do. Do they need to fundamentally change anything in human capital, relational capital, or structural capital, and over what period of time? And what this turns into, in their case, is a deliverable, which is a value ledger, which is a baseline of how they're performing, the investment roadmap, and getting into the sports analogy of it, expected value. What can you expect to happen as a result of making these changes 3 months from now, 6 months from now, a year from now, 2 years from now? In this company, we were able to kind of stretch it to about a 3 to 5 year because they have a very long consumption cycle in their industry. Like the typical product lifespan takes about a decade before it's refreshed. And a typical buy cycle is over 3 years. You would not use the same timelines in a CPG firm. You would not use the same timelines in an automotive firm. But kind of to give you a sense of it. So what did we go and identify? So they were over-invested in salespeople. So the biggest concern that we constantly kept hearing is our salespeople don't have enough people or companies to go and sell to. When we dug deeper into it is their salespeople were siloed across their multiple product units, not cross-trained and not cross-incentivized. So something like, I think, the lowest renewal share of your annual take as a salesperson was, I think, 57%. So you just have to do nothing, and you got 57% of your quota just from your customers renewing contracts. And I think the highest product division was in like the 70s or something like that. On relational capital, they were severely underpenetrated in channel partners. So this was a company that was several decades old, and there's a dramatic change in channel partners over the past 5 to 10 years. They just didn't respond to it. They were playing catch up. And what also arose is, because it was a conglomerate of acquisitions, the master brand was not recognized across their product portfolio. So their own customers didn't realize, because they were buying 2 different products, that it was actually from the same company at times, which kind of goes and tells you the damage and risk that is there. And the majority of the R&D was not commercialized by the company, which was kind of one of the biggest red flags that we went and saw. A large share of the revenue was going towards R&D, but if we apply the Qualcomm principle, we couldn't find a significant share of revenue from the previous 5 years that had been from R&D from the 5 years before that. So this is, again, simplifying. A lot of it was there. So when we went and started taking a look at a combination of their internal data and the market demand data, there was a few things that we went and identified. And what was there was the relationship between pipeline. So for those of you not as familiar with B2B, this is called like the potential for contracts to be signed by prospective customers. And then the demand spend was how much they were going and spending on marketing towards driving demand to this company and its product suite. And what you're seeing is an R squared of 0.45. And we started with a statistical analysis just to kind of get that baseline understood across all people. The real value was getting into the component parts. Now, inside this organization, they were using last touch attribution. So if you're more familiar with B2C, this is going and giving Target the attribution for the Huggies that got sold on the shelf, not for P&G for creating it. So Huggies would get 100% of the, Target would get 100% of the last touch attribution. In this organization, sales was getting like 90-some% attribution, and the rest was going to channel partners. And the other issue was, this was common refrain through our internal audit, which is, well, marketing really needs to run a campaign this quarter because we need to book more. We're not hitting our targets for this quarter. There's very similar examples from B2C. You know, let's go and run a price campaign or, you know, a flyer campaign, a front to flyer campaign, et cetera, to go and drive it, et cetera. And then when we dug deeper into the numbers, so the pipeline was just call it all opportunities, but then we actually took a look at what was the relationship between what we won. And we could explain 70% of winning and the next product sale on whether there was a change in marketing during that company's buying process of the next product. So they spent more on marketing during that company's buying cycle. It explains 70%. And that's just marketing spend. We're not talking creative, we're not talking geography. We went and dug this deeper to see how it held on geography. We went to discover that different geographies were better or worse than the broader organization at knowing and driving these things. So why does this matter? So we then went and started really understanding, well, how, why, and when does the company make money? So some context. What we went to learn through the data is that a process.
Go back to the previous slide. Now, is it feasible, that expansion which you are talking about?
So this is buying a second product or service from the company, or buying an upgraded version.
Customer doing.
This is the new customer
Right.
that you just got, say last year, going and buying an upgraded version of that product or another one of your product portfolio.
I understand. Is
Yeah.
that feasible? Is that feasible?
Is it feasible for the company to do so? Oh, that's a lot of its focus. They're constantly trying to cross-sell, upsell.
Yeah.
But the marketing department is the one facilitating it. The salespeople were not trained to go and take a cross-sell, upsell request. They would literally send that new customer to the beginning of the salesperson's buying process in that different department, which sometimes was in a different geography, operating in a different way.
It is possible, but they are not doing it. That's
Correct.
what-
Yeah.
So just to be clear, they would do this.
One other comment I want to make. You mentioned 3 types of capital
Yeah.
as a way of evaluating the company. Okay.
It's not evaluating it. The relational, the human, and the structural is the environment that it's in. through
Yeah,
those 3
right.
lenses.
Taken
Yeah.
together,
Yeah.
that is the worth of the company at that time.
It's the potential for value. It's
Yeah,
not the
that's
actual
right.
value.
If I accept these terms, that will be the valuation of the company, right? Now, how many companies do that? That's my question.
How can they go and do this? Like,
How
do
many
this
are
in the
doing
whole
it?
process?
How many do it?
How many do
How
it?
many are doing this?
How many companies normally do that?
They're not-
Public
Okay,
disclosure almost
let me pose
non-existent.
the question differently.
Yeah.
The proposition you're making, is it a it's not a normal one, it's a recommendation to companies or consultants to do this.
Correct.
Do this kind of work.
Yeah, so the standard recommends you do
Is that
this.
the way to interpret it? That's what I'm
Yes,
asking.
yeah, so the recommendation is to do this
Yes.
inside a company.
Right.
What we have gone and learned is that less than 20% of companies are systematizing the future drivers of value, from at least the ones that we spoke to anecdotally through the R&D process of the standard development.
But this is a company which is an ongoing company, not a
This
company.
one is. This is a real company
I know.
implementing it
Yeah,
and
the
leveraging
previous
it.
examples which you had,
Were speculative.
potential failures or
Yeah.
failures.
Yeah, that was our kind of our rationale for why this would be important.
Edgar, you have 2 minutes.
2 minutes?
2 minutes.
Okay. Oh, this is gonna be
go
a fun
ahead.
2 minutes. All right. So context. Their buyers and buying teams, so multiple people from a company would be buying the same product from our client, were spending 6 to 30 months before it was given over to sales. Just interacting with marketing assets and public domain information about the company. Then there was a quarterly handoff. So here's an example of nearly $90 million in potential opportunities for salespeople to convert. In the quarter handoff, they converted $4 million.
Jeez.
4 million the next quarter, 8 million so far over the next 2 years. That 86 million still has not been fully settled. They are still looking at signing contracts for the portion of this 86 million. The same applies for all of the subsequent quarters, with pipelines ranging from 6 to 8 million to almost 100 million at any given process of conversion at any given time. So we went into a cohort-based analysis by going and taking a look at, and we now looked at over 400,000 company interactions with their respective individual interactions, which is now getting to the 10 million plus or more marketing interactions and the several million sales interactions to be able to go and do this. Why is this relevant? Well, everybody was looking for the $100,000 deal. Guess what? It takes over a year on average to get to $100,000 deals on average. Yes, you can get some in a quarter or two, but if you want to get the really big ones, it's going to take you more than a year after the handoff to sales. So why is this so critical? They had an aspiration of growing revenue by 45% over 5 years. That doesn't sound that bad, right? B2B technology company, everybody's growing 15, 20% per year. You should be able to get 45% off in 5. However, that's their revenue for the previous 12 years. So now the mandate from the board is grow 45% by 2026 with no historic evidence. And why were we retained? How much do we need to invest into the company to be able to hit a 45% revenue target? So what did we go and do? Well, we looked at, what were they doing? They were looking at TAM, $71 billion. Lots of opportunity. This company was less than $5 billion in revenue. Folks, there's over $60 billion in upside. Well, we ran it through the systems, and we went and identified that their relational capital, so their maximum potential, if they hit every single bat, got every single home run, right, $25 billion. What was it in reality? Their best of the best, so call it their best product market fit ICP definition. Only 13% of it was winnable based on the present state of the business, but it would have $3 billion in value. But they would have to change how the business operated to take advantage of it. They would have to invest into being able to go and make this happen. So,
and optimize the living heck out of it.
correct. So the irony of ironies is they were looking at further cutting costs to achieve growth. I don't know if you've any of you run into that. Let's cut the budget so we can drive growth. This was happening. So I'm going to walk you through this one because this was called the money slide to the CFO. We went and identified getting this model built. We now had a zoom forward, zoom backward understanding of how the business went and generated money, when, where, and through what types of customers. And the question was, can we take $1 million from this quarter and give it back to you next year? without an impairment? No. If they cut the budget, they would lose cumulatively between $1.4 and $4 million in net cash after operating costs. From cutting the marketing budget by $1 million right now. If they wanted to make it back, they would have to invest $2.3 million next year.
So in my interviews, right, this whole cutting to achieve growth thing came up. I didn't bring it up, but they brought it up. And I said, well, what exactly do you mean by that? Because I said, you know, on its face, it doesn't hang together, and yet you're an entirely accomplished, competent, rational human being, right? So it must make sense to you in some way, shape, or form. What is that? The response was always, growth in what? And I said, okay. So I said, the only thing that I can think of right offhand where you could define growth in a way that it aligns with how you're comped, is key to this whole thing, is growth in EPS.
Mm-hmm.
And since you can't control the top line, you diminish the expense line, your EPS grows, right? Everyone's happy, at least for a certain period of time, and you collect your comp. And I never got a on the record or even verbal confirmation of that, but they didn't have to.
Mm-hmm. It's implied. Yeah.
So that's what that is, just so you know.
That's exactly it. So where are we at? So we now have an understanding of what the potential for this company is. If they do not change their budgets as they are, they cannot achieve their growth target. In fact, we identified their peak annual growth would be 7% if all things hit right in a year. Their historical models were completely out of touch with reality, and we were now able to go and explain their forecasts from previous years as to why they didn't achieve their target by showing them this data over time to show that they never went and generated enough investment. And this is the part that was really crazy. They could have invested marketing fourfold efficiently, meaning they would have dramatically increased revenues, and they still would not have hit the growth target. So they would have not just had to do a financial investment spike, but they would have had to fundamentally restructure the business to be able to reach a 45% revenue growth target, because what they, as their business, didn't have the demand in the marketplace, regardless of the fact that their industry analysts and management consultants told them it was $71 billion. And on that note, thank you, Frank, for the extra couple minutes.
Are there any standard errors for your estimates?
I'm sorry?
Standard errors.
Standard errors? Oh, yeah.
You can compute those, right?
No, these have been calculated. So the internal measures are very, very accurate. Like we're getting to like over 90% representativeness
I see.
at predicting. Like when we're looking at 8 to 12 dimensions of information to predict the future sale, and it was substantially more accurate than what they were doing before in traditional pipeline waterfalls. We rebuilt their entire sales qualification and marketing qualification algorithm. From that alone, no change in marketing budget, their revenue went up 26%. From marketing source leads. Yeah. Yeah.
Would you say the long-term, I don't know if it's goal or whatever, would be for the board of directors to want to do this before they say 45% is what's required?
That's the aspiration, which is called responsible forecasting and planning that's there. So in this company, the board is fully aware of this exercise. It has been presented to them on multiple occasions. And let's just say that there's a lot of the men in the room in terms of the ambition that had been set. And as a publicly listed company, they have had some...
How far out have they guided?
They went... So a year and a half before we started working with them, they gave a 5-year revenue guidance. Yeah.
They are so screwed.
Oops.
All right, I think that's all.
Yeah, I mean,
So,
it's hard
so
to
what
make
you
it
do
hard
with
for an
the
opportunity. It's hard.
so what you do with the sales data, that is something because I implemented so many customer projects.
Yeah,
And I think one of the most delighted persons in the room, but maybe not, is the CFO, because like from this cohort analysis, you have the retention rates, right? And assuming they continue, the only wiggle room you have for financial projections is the money you actually invest into new customers.
You got it.
Everything else derives from the cohort and its retention rates and the number of products you have, right? And so you're bound by your past, and you have to accept that.
yeah.
And so we also got this kind of fancy projections, and it said like, how, where from? And then you have these 3 pictures of the sales bars, like the cohorts where they come from. And actually, I think even accounting can learn a trick from marketing if they would report or forecast their sales from these cohort models. They would be much more accurate.
You're literally just reinforcing what this work is going and showing for these companies. And this is, by the way, one of many companies that this is being.
Oh, it's all of them.
Yeah. So we have to stop at this point.
Okay.
Yeah. But thank you very much.